So with that, I'm going to introduce our panelists. We have Dave Danielson, who is the CEO of Student Debt Solutions. We have Melissa McGuire, who is the Senior Subject Matter Expert and VP of Products. And then we have Andrew Mason, who is a product manager and a HUD certified housing counselor with the National Foundation for Debt Management. And with that, I'm going to hand it over to, I believe, Dave. And Dave, go ahead and turn on your camera.
Thank you, Ellie. The host has stopped it, so I need Ebony. I think I need you to turn the camera on, although it's not a requirement for me, but I don't seem to be in control. There we go.
Started, and Ebony will address
It'll
that.
it'll be fine. The content is what's important. And Ellie, once again, as I've said a few times, we're very appreciative to be here, and we really appreciate the opportunity to work with you and the great audience here at NHRC. Really quickly, just there's three speakers here. I'm going to talk a little bit about Student Debt Solutions, our software product. Andrew's going to give you some ideas on what is it like from a user's perspective, and why does this matter to a homeowner or prospective home buyer. And Melissa is going to discuss a little bit more about what's the latest with the loans, the repayment plans in this shifting environment known as student debt and federal programs, as well as private loans. What's the latest? Why does it matter? And just to keep everybody up to speed. We also, if anyone's interested, we can offer a demo here at the end of this session, but we're going to provide a link here in this slide deck that also lets you know how to click and get a private demo or come talk to us. So let's go ahead, Ebony. Thank you. And we can go ahead again. So I like to start with why we're here. We do a lot of work in a number of marketplaces, including housing, and we're really motivated about housing because we know from our studies and from work we've done that a large percentage, somewhere close to 40% of first-time home buyers have student loan debt. We also know that reduction in student loan debt monthly payments can make a huge impact on the purchasing power or sort of the opportunity for a home buyer. And Andrew's going to touch a little bit more on that as we get there. We have made our product easy. So we want you to know, I think if it's one of those, if we forget everything else, we want you to know that our product is easy. Our mission is to make it easy for you to help your clients without you having to be a student loan expert. So we've made it's all in software, and essentially the analysis is done by the product, and it's based on well over a decade of experience. We have included, as Ellie pointed out, we've reduced, and I'll touch on this more, but our list price for using the product is about $89.95, about $90. We've reduced that by a third, so it's a $60 price to use it for the consumer. And in addition, if you choose to be a partner with us, there's no obligation by you, but you would receive out of that 60, you'd receive a $20 rev share payment. So we're trying to make it beneficial for you as well. And again, when I say that we have a no risk solution, we do the counseling, we do the analysis. You don't have to answer the questions about student loans and why this and why that. You provide a link as a referral partner to your clients, and they do self-service. And we'll talk a little bit more about that as we go through. Ebony, next slide. So we have a software program. It takes about 15 to 20 minutes for someone to go through it. One of the hallmarks of our program is that there is no charge for someone to just use the program and see if they can get a better repayment plan. Typically, 90% of all student loans are federal student loans. That's the biggest part of the problem. We've all heard the big numbers: 1.6 trillion, 43 million borrowers. We see similar numbers in our own private analysis. So the bigger part of the problem is federal. However, there are many really good programs to reduce federal student loan payments. Most people don't really know how to navigate them. And so that's what we're here to do. We simplify that process. And again, it is free. There's no risk. There's no credit card up front for you to have your clients just go to our program and go through it, take a 15, maybe 20-minute session. Everything's customized for the individual based on their loan profile. And if they can get a better plan, then they may decide to go forward. And if they do, they would pay us the modest fee that I mentioned for the forms, the instructions, tools to help them fill out the paperwork, and a number of other things. We also offer expert counseling in situations, usually only about 10% of the time, but in situations where someone has a particularly complicated situation, or they're really not sure what to do. They've got two good options. So we do have the counseling available as well. And again, I'll touch on those prices in a minute, but they are aggressive, and we've discounted them for NHRC members. We also want you to know that this is not a new program. Student Debt Solutions has been around for about 13 years, and it's based on essentially primarily Melissa. She's called VP of products, but she's been with us from the start and is really an expert on student loans. And what we've done is built what a counselor needs to know into our software, and built it in a way that we can adapt it very fast. So when things change, goodness knows we're in a very volatile environment. With the SAVE program was good, then it was on hold. Now maybe it doesn't survive the next administration. We can make those kinds of changes in our software very quickly and make sure that we're always providing your clients with the best possible solutions that they're eligible for. We only tell people what they're eligible for, nothing more. So there's never a problem where they try to apply and find out, well, you can't do that. Let's go to the next slide. Let's move on again. I'm going to try to abbreviate mine so that we can move into the meat of things. Thank you, Ebony. So here's what we're seeing. We have lots of clients that run through. We do analytics about every 6 months to take a look back. We were seeing about, in the second half of last year, about 94% of the people that use our program have federal student loan debt. About 22% have private student loan debt. And while there are many more options for the federal student loan debt, and we certainly cover that comprehensively, it's important to help people with private student loan debt as well. Sometimes it's renegotiation, sometimes it's loan modification. There are a number of programs. Sometimes it's a forbearance. We give them some strategies, give them some guidance, and in some cases, we may even refer them to other experts in a specific area that they need help in. Here's what we're seeing in terms of general population. About 75,000 people come in with federal student loan debt. Their average monthly payments are about $740. Now, this is averages. Some people are very high, some people are smaller, but on the average, this is what we're seeing. And after they go through the SDS program, we've found ways for them to reduce their monthly payments by about 60% and their total repayment by about 50%. We've identified forgiveness options in about 50% of all users. And forgiveness means, probably the most common one that people know about is forgiveness based on your job. If you're a public servant, you're in the police or fire, or you work for a nonprofit, or et cetera. If you're a teacher, work for a government agency, those enable you to extra benefits. We identify that through our customized questionnaire. And cancellation is something that we do uniquely. Cancellation is a situation where, if the borrower has gone to a school that has either misrepresented their value, or they closed and shut down before you got your degree, there's a handful of situations like that. There are opportunities and processes to go through to possibly get cancellation on some or all of the loans that were taken out for those, for lack of a better term, let's call them a bad school list. I don't mean to cast aspersions, but by looking at the data that we look at, we're able to help people, if they're in default, get out of default. So default strategies, which is Now that we're going farther into the repayments, that's going to become more common. And we are also looking for cancellation. So those two things, in addition to just helping to find a better repayment program, is what we mean when we say that Student Debt Solutions is a comprehensive solution for people. I put the slide, the pie chart on the right here to identify that the biggest reason, if there's a headline as to how do people save so much money, the biggest reason is that 61% of borrowers, fully 20 million estimated as of the early part of 2024, about 20 million people hadn't taken advantage of an income driven program. Now, not everybody, it doesn't make sense for everyone, but for someone that it does, it basically indexes their payments to a typically a 10% of what their disposable or available income after expenses are paid out. Melissa can talk more about these kinds of programs. But the biggest thing is for people to save by that. And as Andrew's going to point out, if you can save a few $100s on monthly payments for your borrowers, you may enable them, or for your clients, you may enable them to get a better deal or even get an opportunity at all to get into their home. Let's go ahead and Melissa will talk more about the SAVE program and where it is and why that's an issue of importance in today's marketplace. Let's go ahead. So what are we doing that's unique? It's a comprehensive analysis software suite. We've integrated the counseling. We take care of counseling, plus this is the expert student loan counseling. But we've also built the product so that if you have a counselor that you're particularly fond of, SDS can actually schedule with that counselor as well. There's a lot of flexibility here in who you use as a counselor. But the main message I would have for you is we take care of it so that you don't have to worry about it. Robust set of management tools. As a partner with Student Debt Solutions, you have access for no additional cost to what we call the agency portal. This is a management tool that allows you to check on the progress of your clients. Have they started the program? How far along through the program have they gone? What's the results of their program? What did they find out that their payments could go from X to Y? You get that kind of information either in emailed reports to you or by you going into the application and taking a look for yourself. API integration may not matter to you personally, but we want you to know that Andrew is familiar, for example, with a platform, a housing platform called Home Prep. And we're integrated in that platform so that if you're a user of Home Prep, you have the ability to use Student Debt Solutions right within that platform without having to go outside. But we also don't want you to think that that's the only way to use us. So you're going to see Student Debt Solutions either on your own as an individual partnering with us or integrated in platforms. And one example of that is the Home Prep platform. The last point here, multiple marketing channels. When I say marketing channels, think of that as it's actually a link. Like if you would go to a website, you'd use a link. We have the ability to have any one partner, NHRC or your own business, to have one or more links, and that gives you the ability to offer different pricing programs to people or different programs, or you could use the product this way or don't offer this product. So we have some customization that can be done. Typically, one link, one marketing channel is all you need, but there's a lot of flexibility for you to use this product in a way that best suits your business. We've really built Student Debt Solutions to be partner friendly. We don't go direct to consumers. We only work with partners, and we prefer to work with partners that are in the nonprofit space or in the counseling space where you're accustomed to working with clients and trying to help them out. It's why we've kept software as our focus so that we can keep our prices down and make it available to more people. Next slide, please. Very quick idea here as to what I meant by that. So client, this would be your client. You as a partner would either add the client or you would simply reference them to a partner website, that's our website, or your email. And that unique link is your way of telling them, here's how you use our specific flavor of of student debt solutions. And when I say flavor, I'm only talking about customization, colorization, products. The fundamental functions of what SDS does is the same. You can manage your clients by using the agency portal, and counselors can use it if you're partnering with other counselors or our counselors through the agency portal. So this is just a little bit of a chart about how we work with and how you refer people to our product. Next chart, please. Uh, I'll leave this here. Just wanted you to see this workflow. It's really easy for someone. They go through to create an account. The reason is that they can come back anytime for a year if their life situation changes, family size, employment. Often those kinds of changes can result in different opportunities for them in terms of repayment plans. So they're welcome to come back anytime up to a year and retake the questionnaire and go through and see if something has changed. They give us a light bit of income, family size, and goals, like I want to get the lowest monthly payment I can. They import their loan file. We give them instructions and guide them on how to do that. That's a file from studentaid.gov. They answer some customized questions about occupation, disabilities, things like that. And then we show them all of their plans and what their options are. That's no charge, no credit card up front. So that's literally no charge. There's no risk to let people see what their opportunities are. So what happens when people do that? Well, they may be just researching. If they're still in school, they may be saying, well, what's going to happen when I get out of school? But if they see a plan that they like, they can then choose one of these two plans, standard, which includes, if you follow my colors here, required forms, instructions, and the assistant tools to make it easy for them to complete their forms. Or if they choose premium, they get everything in standard, plus they have a live counseling session as well. Again, it's not typical, but it's available for anyone that needs it. And they do this through the Action Center, and they also get a document, a PDF document called the Action Plan, which details their experience, their current loans, the results, and what they've chosen, and what the action plan is, or the steps required to make that plan a reality. Let's go forward. This is a busy slide. Try not to be taken aback by it, but we wanted you to see what is a recommendation. Any one borrower may have. We'll give them. Here's the best we think that This is the best solution for you. But typically, someone will have a dozen different plans. In other words, here's everything you're eligible for. We try to summarize. Here's what works best for you, and the information we provide them is there's a lot here, but it's all useful. On the one side, the top left, these are the basic parameters that most people really care about. If you choose this plan, this is what your monthly payment, total repayment goes to. Here's how much is forgiven at the end of the loan, and this is how many months are left in the term. We also have tools to allow you to compare. How does this compare to my current situation? Or what do you mean by a consolidated pay-as-you-earn plan? What are the plan descriptions? And then we also have, for private loan situations, referral options. If somebody's truly looking to try to refinance or get a loan modification for their private loans, we have some private options and some referral links to help them out there. It's not the only thing we're doing for private loans, but it's sort of an extension that we're trying to build on to help people as much as possible. And then in the main part of the body, we break out the federal loans and the private loans separately. So we try to deliver these highlights. People see this and they can then see and compare, how could this plan compare to my current situation? Do I want to go forward or not? So hopefully that's reinforcing. And let's go forward from here. And the last thing we wanted to show you, and we'll leave this here so that you'll have this in the recording, but these are the kinds of things, the features that are on the left. And when we talk about everybody can go through to see what they're eligible for, that's what we mean by this free column. You get this information just by going through. So there's no risk. Why not see if I can make my situation better? The standard plan, which is $60, and if you choose to, as a partner, you could get a $20 referral fee on that. That is the price the consumer would pay, and that's for 1 year of access. They can come back as much as they want, as often as they want, run through the program again and again. And if they decided to, I'd like to meet with a counselor, they can either pay the 160 right there, or they can pay the 60 and add the $100 later. It's like, whoa, I think I need a counselor. So this is in short, what's offered and what's delivered with the programs. And we also included a link here for if you or your team wanted to schedule a demo or get started with us. Next slide, please. And at this point, I'm going to hand off to Andrew, who's going to give you a little bit of an idea of what's it like to be a counselor at NFDM and an expert and experience with loans. What's it like to use the program and how does it help him? So, Andrew, I'll hand off to you. Thank you.
Thanks, Dave. As a HUD housing counselor, I'm seeing that affordability is one of the biggest obstacles for a majority of the potential homeowners. The housing prices on the rise, continuing to rise in many areas. Every penny counts when it comes to evaluating a client's budget and determining their purchase power. What Dave spoke about with Student Debt Solutions is offer the opportunity to enroll in these income-driven repayment plans, which can significantly lower the monthly student loan payments, their obligations. The income-driven plans are flexible, which is what I like about them. They offer the opportunity for to adjust with income, family size. They even offer a path to loan forgiveness. As HUD housing counselors, before we can classify a client as mortgage ready, we have to ensure that their credit scores meet specific standards, that their budget can sustain home ownership, and that they can comply with current investor guidelines for debt to income ratios. Without an income-driven plan, the minimum monthly payments for student loans can often hinder clients from meeting these guidelines. High minimum monthly payments can also make it challenging to maintain or improve their credit score, make it impossible to save for down payment and reserves, and in many cases delay or even prevent home ownership. As you can see from the slide, reducing the monthly student debt obligation dramatically increases the borrower's purchase power. For every $100 we can reduce the monthly student loan payment, their purchase power increases by tens of thousands of dollars. In today's competitive housing market, purchase power is crucial, and making a strong offer and securing the home is crucial in making a strong offer and securing the home that meets their client's needs. I'd like to share a success story with you. I'm currently working with a client who recently completed law school and had incurred approximately $250,000 in federal and private student loans. His minimum monthly payments on these student loans was over $900 per month. Now, after graduating, he was able to secure full-time employment as a teacher, earning a modest income. What Student Debt Solutions was able to do was qualify him for an income-driven repayment plan, which reduced his monthly payments down to $290 a month. This resulted in an extra $110,000 in purchase power for the client. Most importantly, the repayment plan made the difference between being a homeowner and not being a homeowner. So as housing counselors will continue to encourage our clients to proactively manage their student loans, take advantage of these plans as soon as possible. The earlier they can enroll and benefit from these plans, the sooner we can consider them to be mortgage ready.
Andrew, you handing off to Melissa then?
Yes, Melissa, if you want to take it from here.
Oh, perfect. Thank you. We'll
Sure.
go ahead and go to the next slide. Oh, that's our partner spotlight. And so we'll leave that there. That just is the journey for NFDM and what Russell Graves has had to say about working with us.
Yeah, this is a handout, and sorry, my mistake. It shouldn't have ended up in the slide deck, but we can make this available as a handout.
So
Just,
just to kind of,
just FYI, we popped a link in the chat.
Allie. Yeah, so just to kind of go full circle around what Dave has explained about the product and bringing Andrew's experience and working with clients, it's really important that we're able to help all clients. So it doesn't matter their situation. So a little bit about my background: I've worked in nonprofit credit counseling for since 2011. Um, and that's where we really saw the need to provide a tool that simplified kind of the complexities around student loans to provide access, so clients really, oh, perfect. Thank you. Turn my video on. Hi. So after working in the nonprofit, it really became apparent that we had to find a solution, for individuals not understanding the complexities around student loan debt. It's not always just as simple as enrolling in an income driven repayment plan. And that's the best thing about Student Debt Solutions, because we are so full scope. We're going to cover anything from cancellation, your private student loans, even default resolution. And so we're able to assess any level of issues for any of our clients, whether they're purchasing a home, or they're struggling to, make their credit card payments. It really is a tool, again, that can really fit into any situation for any client. And it was really born out of, again, just really confusing to navigate the complexities around student loan debt. There are some people that can quickly, pick it up and just say, I'm going to pick this, my standard repayment I fell into, and this is fine for me. But especially given the last 4 or 5 years, we're finding that it's becoming even more confusing with all of the changes that the Biden administration was aiming to do. And now we have a new administration coming in. We're finding, well, what is SAVE? What's going to happen with the SAVE repayment plan? This is an income driven repayment plan. I will talk a little bit more about it in a second. What does this cancellation or forgiveness mean for me? A lot of times we mix up what forgiveness means. It can be something based off your occupation, or it can be associated with a type of repayment plan that you're in. And are you going to achieve that forgiveness? I work with one of my close friends who's a nurse, and she always says, well, everyone else is getting forgiveness in my in my hospital that I work with, so this has to apply for me. And I take a look at her situation, and that's not the case for her, because of different factors like our income or our family size or the amount of student loan debt that we have. Just because our friends may get that option for them doesn't mean it applies to everybody. And so just navigate, and that's just a really simple case, but navigating those complexities, again, is very difficult. So really our mission with Student Debt Solutions, when we first started building this application, is to empower our clients and empower borrowers with the knowledge of every option that's available, really irrespective of their situations. And in nonprofit, what we found is that in order to do an analysis of an individual situation, it's not as simple as pulling up a calculator and seeing what the options are. We really have to do our due diligence, and of the mission of being holistic. We have to navigate every situation. And if they have a private loan, a federal loan, have they consolidated their student loans before? Do they have a Perkins loan, a Parent Plus loan? It's going to lead us down a different pathway. And that is a hard obstacle to train. It's inside of our own nonprofit agency, we were finding, how do we take this subject matter and then transpose that to 5 other counselors? The time that it takes to work with individual clients, that's a lot of overhead that we have, and we're trying to keep fees low by offering this as part of our solution inside of our nonprofit. But the intake alone can take a really long time. Navigating the obstacles and the options can take a really long time, and that equates to, well, where do we get the funding for that? And so we've always kept our fees low. We wanted technology to support it as well, because with technology we're able to streamline these processes. First it started, well, let's just figure out how we can get intake streamlined. And then let's figure out how we can get the option analytics streamlined. And it's just iteration after iteration, as long as Student Debt Solutions has been around, is where we've ended up with this product now. And the pandemic has really given us that opportunity to create something that we can share with you guys, to share with other housing counselors, housing agencies, mortgage loan officers, whatever it is that you can have access to, attain, and then share with your clients. And the National Student Loan Data File is a specific file that allows us to be as comprehensive as we are. We don't just simply pull a credit report. This particular federal student loan file is key to the process and really unlocking those answers. I'm going to go ahead and go to the next slide, please. So I want to just go through some updates of really where we've been, leading out of not just 2024, but kind of this administration, and touch on where we're going, because I think it's really important. So we'll hit the next slide. Thank you. So just a quick overview that a lot has happened, and I think it's going to owe to the complexity. So this is a really great time to be here. And again, thank you for the opportunity. We're really excited to share our product and some of this information with you. We returned to repayment on federal student loans on October of 2023, and student loan clients were given 12 months, what the administration was calling an on-ramp. And essentially that said, we're going to start you in repayment, but if you miss a payment, or if you're not sure how to get yourself into a repayment and you fall late, we're not going to report those late payments to the credit bureaus. So we're still actually not reporting on that. People are essentially late. As Dave had pointed out a statistic, we actually have a very high increase in delinquency right now, higher than I've ever seen it as long as I've been around dealing with student loans and in the space of student loan counseling. But again, those late payments are currently not essentially being reflected to the credit bureaus, but that is slated to begin this month. And then we also had an opportunity of, if you were in default, so if you are a student loan borrower, and what default means on the federal student loan level is after 270 to 360 days of missed payments, you'll go from being late to being in collections, okay? And then they're going to default you. There was 10 million, about 10 million borrowers in default leading into the 2020 and that pandemic era of student loans. Now, currently, we stand about, I think it's about 8 million borrowers still in default. And so that's a large segment of individuals that are going to need assistance. Currently, we don't have collections occurring on those defaulted borrowers. And that's going to be something that's going to rear its head later this year as well. We'll find out with this administration when that'll probably begin. With the SAVE repayment plan, this is an income-driven repayment plan that replaced an existing repayment plan called the Revised Pay-As-You-Earn plan. The Revised Pay-As-You-Earn essentially had around 7 million borrowers in it. And if you were in the Revised Pay-As-You-Earn, you automatically got flipped over to the SAVE plan. Now, there's been a lot of controversy in court litigations that have impacted the SAVE repayment plan. So we have to wait and see. I'm going to go more in depth in that here in a minute. With the borrower's defense to discharge, we've had a lot of forward movement. We might see a lot of, we probably see a lot of, another 500,000 borrowers got their student loans canceled. So this administration was very proactive in providing assistance to borrowers who attended a school that essentially was associated with misleading practices. So we saw a lot of discharge take place under that guideline, which is really great. I think that borrowers were owed that. So we saw a lot of positive implications through that. We also saw PSL reform, which was amazing. So these were credits given back for certain eligible borrowers who were eligible if they worked in a particular occupation. That provided them an opportunity to achieve forgiveness on their student loan in a shorter amount of time. That's over 10 years. So, and we saw a lot of reform around that and a lot of cancellation in association with that. We also saw one-time account adjustments and credits towards time and forgiveness. And this was really due to some misdeeds by servicers and things of that nature. And so we saw a huge a huge benefit. This is a really great thing on the IDR recount. However, many borrowers are still waiting for those adjustments to reflect on their account. Was slated to be done in September of 2024. But we're still seeing some confusion and some complexity around that when we speak to student loan borrowers. We're going to go ahead and move to the next slide. So to elaborate a little bit on where we're going. So the first thing I like to talk about is the default collection. So for 2025, our collections on defaulted student loans is set to resume. And we're going to see huge impacts as borrowers are going to begin to see these significant changes reflect on their credit reports. And however, the biggest impact is going to be through the mandatory collections. So this is with Social Security. If you receive Social Security income, not disability income, but just SSI, if you're filing your taxes and expecting a refund, or if you're employed and have been employed for a certain amount of time with your employer, you can potentially see wage garnishments or offsets against those sources of income or revenue back to you. So this is something, again, we do expect increased default rates and for borrowers to have a call for need of assistance due to the collections resuming this year. We're going to go to the next slide. Just to elaborate a bit more on the SAVE repayment plan, we know that the litigation is still lingering there around the SAVE repayment plan. It will still be outstanding as we change from administrations here in a couple of days. So the laws that created SAVE also impacted enrollment to other income-driven repayment plans. This was the pay-as-you-earn, or the PAYE that you see here, and the income contingent repayment. Now, in December, the Biden administration did open enrollment back to these two plans. So that's really good, as that limited access was kind of leaving borrowers who wanted to get out of SAVE at a disadvantage, particularly if like the pay-as-you-earn was a better repayment option for them. So those are opened back up, and they started processing borrowers who are requesting those plans. They started processing those applications as of a few days ago. So this is very good news. Essentially, if you're a borrower who is enrolled in SAVE currently, you're going to be experiencing a 0% interest forbearance. There are some downsides to that, as I almost like to think of it as you're kind of just in limbo. You're in a plan that's not exactly, particularly legal. And so there's some consequences to potentially accruing time towards that forgiveness. And so it will have to wait and see what happens with this plan. We'll go to the next slide. I have some general inquiries on maybe what can happen. So our beliefs is that it's likely essentially that the Trump administration's just going to stop defending the SAVE plan. Since it is in appeals, they can just say, we don't really want to defend this anymore. Let's get rid of the plan. In almost layman's terms here. But what does that likely mean? So we suspect that the borrowers who are enrolled in SAVE currently, they're going to revert back to the plan that it replaced, which was the revised pay-as-you-earn plan. So this is a really great plan as well. It does allow borrowers with direct loans to enroll. The payment is calculated slightly differently than SAVE, which is just 10% of your discretionary income at 150% of the poverty guideline. So individuals will see their payments increase from what they may have expected under SAVE. There is also a generous interest subsidy. It's not a full subsidy, which was what SAVE offered. And there's no partial financial hardship on this plan, which is really great because if you start making a lot of money, you aren't going to risk being removed from that income-driven repayment plan. So revised pay-as-you-earn is still a great plan, but there are some other alternative possibilities. We could maintain save and it just have modifications. Maybe we'll see an overhaul of income-driven repayment, or is this going to be on a continual delay? So we have to, be mindful of these possibilities when we're speaking to clients, but just kind of understanding all. But I think it's pretty common opinion that we'll just roll back to repayee. Any overhauls or modifications are going to be legally complex. So I don't think we're going to see, much much of that in this administration to try to change student loan repayment. We'll go to the next slide, please. With other forgiveness programs and income-driven repayment, we did want to throw this out there because I think there's probably, coming from one administration that was so pro, student loan forgiveness, cancellation, let's find ways to make this easier. Now we're leading into an administration where people are, that's not going to be the case. I think one of the things I hear is like, well, what's going to be the fate, of forgiveness or the fate of income-driven repayment plans? What can happen to public service loan forgiveness? I like to use the last, when the Trump administration was here before, we didn't see, a call to eliminate any income-driven repayment plans. So there was a call, though, to streamline income-driven repayment to make it less confusing and more easily accessible. They had talked about, potentially just having one income-driven repayment plan. But again, I just think that with the legal complexity around it, kind of leaving from where we were with all of the legal, complications that we've experienced with student loans, that moving into this administration, I think that's highly unlikely. I think we're just going to, get back to business on, having to repay our student loans and moving forward. And again, that's just my opinion. And with public service loan forgiveness, there's bills that have been floated, let's eliminate public service loan forgiveness. However, doing such an act would require Congress. And so I don't think that there would be anything necessarily to change around that, around public service loan forgiveness. And I always like to put this, because it's what I tell every one of my clients, is that, if there was a move to remove public service loan forgiveness, it would be what we call applied to any new borrowers. So new borrowers as of October 1st of 2025. And I'm throwing that out there as an example. It would not be retroactive. So if you were currently in public service loan forgiveness or had older student loans, because in your legal application, when you received that loan, it stated you had access to the program, and that will maintain. We'll go to the next slide. And that's all I have. So thank you so much. I'll pass it back, Dave, if you want to, say thank you and all of that. But we wanted to provide you some links. And Dave, I'll let you sign us off.
Well, I want to hand this back to you, Ellie, to see what's next. We've had a lot of great questions come in. I didn't know if you wanted to dive into them or how you'd like to handle it. I slipped up and answered one, but my apologies.
We'll dive into the questions right now.
Great.
So I will remind people, if you've put questions into the chat, I'm unable to really keep track of them in the chat because the chat keeps rolling. So please, if you have put a question into the chat, please put it into the Q&A box. That's where I kind of track the questions. I don't want to miss anybody's questions. You all always have like the best questions. So a couple of different people asked about the fees associated working with you all, and one person was asking about that you kind of repeat that again, and also wanted to know about how is it not a conflict of interest for them to refer somebody to you for a fee?
Well, a couple things. First of all, the the fee for a client to go through, if you refer one of your clients to SDS, they're not going to pay anything unless they see a plan and they say, "Hey, I'd like to take advantage of that. How do I make this plan a reality?" Then there would be a fee of $60. This is a discount of 1/3 over our list price for NHRC members. Um, and that would be that would entitle them to the required documents for that plan, instructions specific to that plan, everything they need to do to make that plan a reality. If they wanted live counseling as well, they could either uplift that $100 later, or they could do it right at the start. The $20 referral fee is offered to you if you choose to. It's certainly nothing we're requiring. We have we work with lots of people who sometimes they say, "That doesn't feel right. I'm not comfortable with that legally, or whether it's legal or not." And certainly, it's not a requirement of us. And so we offer that as a way to help counselors, and we know that. That finances are tight. $20 doesn't necessarily do a lot, but that's on a transaction or client by client basis. So you may feel that that's well within your rights to take and enhance your revenue for doing the work and trying to help get your client some support. If you don't feel comfortable with it, it is not a requirement. Certainly nothing that we require. Does that help, Ellie? I think.
Yep, I think so.
Yep.
The person that asked that question, if you have any follow-up question to that, go ahead and put it into the Q&A.
Yes, please.
Okay. Let's see. Would this affect somebody's credit score at the time when they switch to this solution?
I'll let Melissa take that better than me.
So a little clarity around that. Essentially, no. It kind of depends on their situation coming into it before. So if they're just switching their payment plan, that's not going to affect their credit. Especially if if end result is lowering their debt to income ratio. So, for example, if you have $100,000 student loan debt, let's say your monthly payment's $1,000, and that was your standard repayment plan, but you found an income driven repayment plan that significantly reduced that. So switching into a payment plan is not going to affect your credit whatsoever. And again, our product is a product that we provide for clients to access to explore their options and provide them assistance and connections to counselors and resources. But the federal programs that we are supporting through our product are just that. They're federal student loan programs, so easily accessible out there in the public, but have consolidated the pathway to those into our software. Yeah.
And Ellie, if I might add one more thing to that, as you know, we cover both federal. While that is the major burden of debt that's out there, we cover both federal and private. We make it possible in order to understand what private loans do you have. If someone doesn't know, we do give them an opportunity to pull a credit report, but that credit report is what's called a soft pull, and it has no effect on their credit score at all. So even if they're pulling a credit report, what our product does is it says, okay, well, we know you have these federal loans from your federal student loan file. We see all of these education loans in your credit report. The difference is, oh, these are your private loans. So now we know which is which. But again, that has no impact on credit. It's what's called a soft pull.
Okay. Does SDS include keeping the client with a federal loan, or does this put them into a private student loan?
No, we don't put anyone into a private student loan. Frankly, we don't make any decisions on behalf of the client. They choose. But I don't know that we're going to get on a soapbox and preach this, but we're really opposed to seeing someone try to refinance their federal loans, because that converts a federal loan into a private loan. And now the suite of all of the federal repayment programs are no longer available to that client. So we really encourage people to don't consider refinance as the first option. And we're certainly not a refinance company, so we're not trying to do that either. We ask people to explore all of their federal repayment options. And if they have private loans, then maybe refinance is an option for those.
Okay. If payments on student loans resumed in 2023, why do we still see student loans deferred with 0 payments? We pull credit reports for clients and there are no minimum payments reported to the credit bureau.
Yes, so I would think that that could be because maybe that client is specifically enrolled in the SAVE. That would be my first assumption. Maybe they're in the SAVE repayment program right now, which is continually on a forbearance due to the litigation. That could have an impact. So that's what my gut is telling me. We definitely see, you know, monthly payments on certain credit reports that we're getting, and so that would come through if there was a payment due. There are a large amount of individuals who are student loan borrowers on some type of postponement or deferment. It's a popular option when you don't know how to repay your student loan or you can't just simply afford it. And we have 8 million borrowers still in that because of the SAVE plan right now.
Yeah.
So probably common to see.
Okay, I think I can answer this question. What is the difference between student debt solutions and Savvy? So there are two big differences between the two options to help clients with student loans. So Savvy deals with federal student loans, and they do not deal with any private loans. So they have all of their assistance and information is related to the federally backed student loans. SDS will address and deal with and help a consumer deal with their private student loans. So that's one difference. The other difference is that SDS is much more a counselor-facing application, whereas Savvy is much more consumer-facing. So with student debt solutions, there is the option for you as the housing counselor to be part of the service and work closely with them to provide the service to your client. If Dave or Melissa wants to expand on that any more than I already have, please feel free.
Well, I would only add one other thing. Thank you, Ellie. I think the most important thing is that both Savvy and SDS are trying to find ways to help people out. So there's really no bad stuff there. We're not anti-Savvy, so I don't want you to think that way. But one other thing, because we use the federal student loan file called the NSLDS file, it enables us to offer strategies for one of your clients that is in default or has an option or an opportunity for cancellation because of attending a bad school or what have you. So for us, when we say comprehensive, we're looking at default strategies, cancellation options, forgiveness options, and repayment options for the federal. And as Ellie pointed out, possibly if they have private loans, some assistance for that as well. Melissa, did you have anything you wanted to add there?
No, I think that was a good question. Thank you.
If we have clients who were in default before the on-ramp program ends and they are at risk of default again, what action should we give our clients to avoid future credit impacts? Call servicer, apply for a specific program, any specific actions that we can recommend now before repayment starts again?
Okay. I'll take it. So if the client was in default before and then took you would think maybe they did the fresh start. Now they've started repaying and they haven't made any payments. So what they should look into, it just really is dependent on their situation. So the first thing that I would do is assess, is there something we can apply to your account right now? So a deferment or forbearance that you're eligible for. We could explore those options and then they would need to call their servicer and talk about those options with them. A lot of times, if you are significantly late, you can get a forbearance that will be retroactive on your account. So it'll roll back those times. Now you're going to have interest issues, interest will accrue, things of that nature. But if the client can't afford to pay X amount of dollars to catch back up, that's going to probably be the simplest method.
To the Student Debt Solutions Borrower Portal.
Yeah.
Student Debt Solutions identifies federal programs to reduce
no problem there.
Sorry about that. I'm trying to get a live link for your demo.
Fine, we can send you one. Dave might be able to help you.
Uh,
Yes, and then consolidation can be a method if they haven't done that before. That could reset their term, reset their options for forbearance and deferment. So those are some secondary strategies that we look at. But if the client should most likely pick up the phone, speak to their servicer, have them reach out, see if there's any deferment or forbearance options, and obviously look for any alternative sources of payments that could be available that are going to just be a little more manageable on a monthly payment so that they don't find this continuing to be a problem. And again, that's where consolidation may work. So yeah, that's some general advice. Again, it's very specific. That's what I say. I've worked with thousands of clients, and I can't say that one client is similar to the next. Everyone's situation is so very different. So it really does just depend on their particular situation.
So I do want to just let everybody know, apologies for that interruption, but I did manage to get a live link for the demo into the chat. The other thing is that, and Dave just put another one in there. The other thing
Sorry.
is that after we're done with Q&A, we should have a little bit of time left. And if there are people who have the ability to stick around, Dave and Melissa did offer to do a quick demo for all of you who are participating today. So if you want to, if we do end up with some time at the end, people want to stick around, they can do that. Okay. Do you work with clients, in parentheses, parents that took out Parent Plus loans for their children's student as well?
Yes, we do. And we have paid special attention to that as well, because it's very critical that Parent Plus loan borrowers are reviewing their options. As consolidation can kind of mess things up. So we do work with, short answer, yes, we do work with Parent Plus loans. And it was kind of a passion project for us to make sure that we're assessing all options for those Parent Plus loan borrowers.
Okay, so yes, there will be a recording of this webinar. It does go out to our listserv. If you're not on our listserv, you should join it. And you'll get all of this information every time we do a webinar. You'll get the information about signing up for it, and you'll also get the recording and the PowerPoint afterwards, even if you don't attend. But if you feel very strongly that you don't want to join our listserv, you can go to our YouTube channel. And if you go to YouTube and just search National Housing Resource Center, it'll pop up and all of our webinar recordings are there. Okay, so somebody said no fee for the client. I think that's a question.
I see not the fee for the client, the financial incentive for a counselor to refer a client to SDS.
Oh, I
Yeah,
see. Right,
yeah,
okay. They're just commenting. Gotcha.
Yeah, the mechanics of that would be that the client would pay the $60 and then we would reimburse you a referral fee if you chose to participate.
Okay. And thank you, Christy. Christy put our YouTube channel and the link to join our listserv in the chat. Okay. And the person who asked that question said thank you. Okay, why are you not allowed to pay down principal on Perkins and other student loans when the interest owed is more than the principal?
So you can do principal only payments as long as you're making your on-time monthly payment for any federal student loan. So there's no prepayment penalties or any of those consequences shouldn't be an issue. There are ways that you should go about handling that with your servicer. So you want to make that on-time monthly payment, and then 2 weeks later you can go in, you can apply another payment, you can request that it be a principal only payment. Shouldn't be an issue.
Are your student loan debt counselors HUD certified housing counselors?
We are not.
Okay.
Yeah.
But can you go into that a little bit further, Dave? It sounded like maybe you were going to go a little bit further.
Well, I was going well, only that, we focus on, and we've actually, as we work with housing counselors, we get asked this question. Our expertise is in is in the student loan intricacies, and the housing counselor is the one that we assume is focused on the housing side of things. So, as it relates to the loan payments and the loan strategies, our focus is trying to help the client figure out, or the consumer figure out how to achieve their financial goals, whether that's I want the lowest total repayment so I can pay it off faster, or I want the lowest monthly payment, which is much more common. And we don't really get asked a lot of housing questions, so it's not something that we have focused on training up that expertise. We often work with nonprofit counselors who also have that experience, consumer debt counselors that Melissa works with a lot. There's a number of others, so I won't do name calling. But we find that there's a lot of people that have similar skills within an organization. But long answer, sorry for what should have been a short answer, is no, we're really focused on the expertise of a student loan expert, which is quite complicated enough.
And it's very clear to me in my conversations with Dave and Melissa that it is their goal to coordinate very closely with HUD certified housing counselors when it seems like that is where the goal is for the person that they're assisting. So
absolutely.
Okay, so this is a question that I can answer. I was recently told that being a certified HUD housing counselor qualifies for loan forgiveness. Is this true? So if you are certified, that means that you passed the test and that you're working for a HUD-approved housing counseling organization. In order to be a HUD-approved housing counseling organization, it needs to be nonprofit. Working for a nonprofit organization makes you eligible for student loan forgiveness.
Yes.
So that's how that question is answered.
It's a big check the box.
It isn't just about having passed the exam. You have to actually to be certified, you actually have to be at a HUD approved, your verification of employment at a HUD approved housing counseling organization. If you are not working at a HUD approved housing counseling organization, you are not a HUD certified housing counselor. Just want to be clear on that one. Okay. How do you assist clients who are on SAVE forbearance and lenders requesting a payment plan?
That's a sticky one. I'm going to defer to Melissa on that because, as she's already pointed out, if you're in SAVE, you're in forbearance, and if you're in forbearance, the calculations about debt to income can be a lot different than you expect. Melissa, I'll hand off to you.
So, and the way that I understand it, is that with student loan repayment, your lender could view that forbearance differently. So if you're in a forbearance, maybe they're going to take the amount like 0.5% of your total amount of student loan debt and just assume that is your monthly payment. So I could see in this instance that would be an issue. So it's something that I've said was probably going to rear its ugly head if you were forced into that forbearance and you're trying to buy a home. And then your lender says, hey, well, you're in a forbearance. And so I'm just going to make the assumption that, your monthly payment is X amount of your student loan debt. So what I would do, but it's going to probably cause issues considering, I don't know how far along the individual is into the home buying process, that when I have spoken on like first time home buyers presentations and things like that, that I felt it was probably necessary to get individuals out of SAVE and into an alternative repayment plan so that it does not interfere with their home buying process. So that's something that you have to proactively do as you get ready for that purchase. And I don't know how it's going to interfere now that you're kind of in the middle of the process. Yeah.
I would add to that, I was going to say the same thing, but it may not be obvious to everyone. But if somebody's in a SAVE program, there's nothing that prevents them from changing that to a new IBR or something else that doesn't have those same restrictions, and where your monthly payment would truly reflect your debt to income ratio. So we do see people who are on SAVE who are coming through the SDS to say, well, what should I do now? What's my best alternative? Even more so when there is some doubt as to whether the SAVE program survives.
Okay. We have partnerships with local lenders to help people become mortgage ready, and one of the biggest holdups we see is student loans. If my agency were to begin utilizing SDS to help facilitate that relationship and help lenders and potential homeowners get closer to that closing table, does that align with the goals of SDS?
It's an easy yes, Melissa, and I could both answer that with capital letters. Our goal is really simple. We've worked from the start to make this easy and to make it possible for consumers to help themselves through the process, which is often complicated, and to give you as lenders or counselors the ability to help your clients without feeling like you had to become an expert in the subject. So that really aligns with us very well, and we'd be happy to help in any way we can.
Great. And this looks like our last question. Can you request a specific dollar amount for student loan repayment based on what you can afford?
Yeah, yes and no. No, the largest answer is no, you really can't. There are things called alternative repayment plans, sometimes with the most extraneous situations. It could happen. But essentially you've got to prove that, you can, if it shows like, hey, I can get in this income driven repayment plan, that's what they're going to force you into. There's something called a reasonable and affordable payment. We really look at that for individuals who have defaulted, maybe defaulted multiple times. And we just really need to set up some kind of ongoing payment to avoid collections, and maintain, the good faith aspect of trying to repay the debt, those types of things. So typically, no, you cannot.
Okay. And there are no last minute questions popping into the Q&A. So I am going to pass it over.